So, will next week give markets more reasons to rally or have stocks hit a wall? Tim, I know we took a bit of a breather today, but all-time highs yesterday.
We were breathless before this, so we needed
We were out of breath. We need a little break, right? But it doesn't feel like a record-setting time. I mean, look at all these cross-currents, geopolitical tensions, slower growth. We're still dealing with stubbornly high inflation. We're slapping tariffs on everybody. Can we continue to push through the tension?
Well, there's no question that if, we've got a couple options guys here that know a lot more about volatility than I do. But if you look at least the absolute measures of volatility out there, it's kind of shocking to have been sub 16 on the VIX, going into yesterday with what's going on politically, what's going on with tariffs, what's going on around the world, and also what we're seeing from gold and what we're seeing from Bitcoin. Those aren't happening in a vacuum. Those are happening as a function of. And that's why there's so many cross currents this week, including, look, we had two great Treasury auctions. Actually, the Treasury should be really happy. I believe they're talking about even a surplus coming in from tariffs and whatnot. But again, long end of the bond curve had some great auctions this week. I think if you think about earnings for next week, I believe investors are going to continue to pay up for growth. Now, in the banking space, it's not as if you're talking about tech stocks, but I do think there are places where you actually will see more versus less growth next week. But ultimately, again, I think the leadership we've seen from semis is interesting. Another theme this week was semis outperforming software. That was the trade that was probably 150 basis points to the favor of semis again today. So investors are evaluating the places they have confidence in their growth and the places they're probably overpaying for it.
Bono, what do you make of where we could be looking next week? We do have a lot of banks reporting financials, though, the worst group of the day, albeit, though, just down 1%.
I mean, I think it's a net positive for all the things that you said. Essentially, we've had all these macroeconomic headwinds. There have been some recent tailwinds, a reversal of what were formerly headwinds. And I think you'll get some quantitative data next week that actually support whether or not you can continue to kind of march higher. So I think rather than it being more of a speculative on or risk off situation driven by macro, driven by the Fed, I think you'll actually get to see whether or not corporate earnings are supportive of the heightened multiples that we find ourselves back in. The last point I'll make is you mentioned it doesn't really feel like we're at an all-time high, but I think that there's two things. You have two juxtaposing factors. You have the fact that we're only up, 6% or so year to date. But if you look at our April lows, that rally has really felt like a risk on a reshoring of capital, reshoring of manufacturing, and those tailwinds that have kind of led people into some of the U.S. domestic stocks, as well as international. But I think it's those two things that kind of pose a bit different thesis or a bit different narrative around how you feel about the market reaching its all-time highs.
That's a good point. I mean, Michael, when we do think about the April lows and where we are from now, I mean, my goodness, the market just sort of says, tariffs, yeah, bring them on, right? I mean, maybe it is the taco trade. I don't know. But thinking about where we were on April 3rd versus where we are now, should we be here? And can we keep going higher?
So the move that we saw, I think, is probably one of the most pronounced over a period of that time, basically since Tim and I have been in the business. So I think on both hands, we could probably count the amount of times that we've seen 20% rallies in such a short period. One of the things I would certainly say is we've had better than expected inflation data on the last few prints. PPI is going to be interesting next week because PPI is going to lead really the core inflation. And so it's going to be interesting to see how that plays out. But so far, so good. The only thing that gives me a little bit of pause is if you're going to look at, price is truth, I kind of would have expected financials to do a little bit better today if people were anticipating a good PPI print next week, because then you would be anticipating some steepening of the yield curve. That's typically going to be good for financials. On the other side, though, the moves that we're seeing out of names like NVIDIA, those are long duration trades typically. These are the growth names. As Bonawyn was pointing out, you're going to start seeing people bid for this as long as we get decent growth numbers. And as far as this, the balance, the fiscal balance, I thought that was kind of interesting, but it's not huge, of course. We're talking about a $60 billion swing. We were looking for I think a $30 billion deficit, and we got a $30 billion surplus. In the context of a $7.5 trillion budget, is that so huge? But it is trending in the right way. We in financial services, we tend to like to look at trends, right, in the early stages. Is it moving in the right direction? That's moving in the right direction. If we can keep inflation under control, we see revenues a little bit better than expected. That's good on balance.